Hi, my name is Daniel Jones, and I am the Managing Director of Fair Assessments, the property tax reduction firm. Today I'm here to answer the question, how does the tax assessor determine value? There are three recognized approaches to value, and this is true of real estate appraisers and tax assessors. They are the cost approach, the sale comparison approach, and the income approach. The cost approach starts with an estimate of the cost to construct the property as of today's cost and today's construction standards. From that cost new estimate, an estimate of the total accrued depreciation of the subject property is deducted, and a land value is then added to that depreciated cost new to get an estimate of the total property value. In the sale comparison approach, properties that have sold that are similar to the subject property are compared to the subject and adjusted to give an indication of what they would have sold for had they been just like the subject. For example, if a property sold for $100,000 and it was just like the subject property, but except for the fact that it had an extra bath, and the market values a bathroom at $4,000, then that comparable sale would indicate that the subject was worth $96,000. The elements of comparison that you adjust for are things like bathrooms or square feet or size and age, presence of basement, etc. Once all of your sales have been adjusted to give an indication of what they would have sold for if they were just like the subject property, then you have to reconcile that information and put a value estimate on the subject. Typically, the sale that requires the least adjustment is given the most weight. The income approach is primarily used for commercial properties. It is occasionally used for residential, but it has to be a very active rental market in the neighborhood to do an income approach on a residential property. In the income approach is based on an estimate of the income producing capability of the property. From that, the operating expenses of the property are deducted to give an indication of what the net operating income is. The net operating income is capitalized into a value estimate. The capitalization rate is taken from the market, and it's an indication of what investors are paying for a particular property type in a particular market area. The tax assessors will often use a cost approach because it's very easy to automate. And once they've established their cost approach values, then they'll compare those values to the properties that have sold. This is called a sale ratio, the assessment to sale price. If those sale ratios indicate on average or on the median that assessments are only 80% of sale prices, then the assessors may increase their cost approach values by 10 or 15% to get them closer to fair market value. Do you have any other questions or comments? We'll be happy to help you out. Give us a call or visit us at fairassessments.com. Thanks. Hey, if you enjoyed this video and would like to receive 20 free videos of the top questions that people ask about property tax appeals, visit propertytaxappealusa.com. And please forward this video to friends and family and share it using Facebook and Twitter, and good old-fashioned email works great too. Thanks.